And Tom, you want to start screen sharing and I'll do the introductions?
Sure.
So welcome everybody. This is our second time offering this workshop for graduate students and postdocs who may have some student debt and who need help balancing their budget and living within a certain income range while they're getting their education, completing their training. So we're very lucky to have the Financial Planning Association of New Jersey offering to help us with this workshop. And we have several people with us today, Tom Duffy, Diane De Oliveira, and Justin Rice. And Edward Bow's not on, right?
No.
Okay. So they're going to be our presenters for today, and I think we'll keep it informal. So if people have questions, feel free to either type them in the chat and I'll ask them, or you can unmute. I'm sure they'll stop at various points to see if people have questions. So thanks so much, and take it away, Tom.
Sure. Well, great. Thanks everyone for joining us today. And Janet, if you monitor the question and answer, that would be helpful, because it's tough enough for me to do one thing at a time, let alone two. So
yeah.
So folks, and we will certainly accept your questions as time goes on. I have some colleagues that are on with us as well, and so when I go astray, and if I say something that doesn't make any sense, which is certainly possible, certainly Justin or Diane, please jump in and correct me.
We'll reel you back in.
Yeah, thanks very much. I appreciate that. Diane and I have known each other for a long time. We served on the board together, so certainly she can bring me back on the straight and narrow. So again, this is the Financial Planning Association of New Jersey, and we'll jump right in here. So one of the things that we wanted to talk about was the B word here, and it's one of the things that drives me nuts. Is it jumps right in there and uses the B word. I'm not a big fan of the B word. When you say budget, to me that sounds like diet, and if you could see below my chest here, you would see that me and diets don't get along. So budgets don't necessarily work very well for most folks. It seems, when we hear the word budget, it seems restrictive. So I like to use the term spending plan. So I want you to keep that in mind when you see the word budget. I want you to think spending plan as we go forward. So a couple of things that we've got to ask ourselves as we move into the next phase, if you will, of reopening, of getting jobs, of increasing our income, of changing or adopting to a new career. We've got to ask ourselves, am I living paycheck to paycheck? Do I have a plan? Am I worried about having enough money to buy certain things before I get paid again? Do I often incur late fees on any credit cards or any types of car loans or things like that? Have I avoided making healthcare decisions because I'm concerned about whether or not I can afford those? These are things that we've got to think about in our approach to our spending plan. Do I want to save more money, but just can't figure out how to do that, or find that it's impossible? I think that it's impossible, and just don't have the tools to do that. So if the answer is to yes to any of those kinds of things, there's two approaches, right? There's a safe approach and a risky approach. The safe approach is that we would advocate is to evaluate our spending. The way I do planning with my clients, in our personal life, I'm a big cash flow. I want to know where every $5 bill goes when I talk to a client. I don't need to know where every nickel goes, but every $5 will suffice. I want to know, how much do we spend on groceries? How much do we spend on maintenance of our house? How much do we spend going out to eat, or today ordering in constantly? I want to know all that kind of stuff. And then I want to come up with a spending plan. And then I have to figure out a way to make myself stick to the plan. That's the willpower, if you will, that we all find so challenging, is to stick to that plan. Right. So sometimes it's just a matter of setting some goals that plan will get us to. Right. So the risky approach to answering any of those yes questions earlier would be, well, we'll just hope. Right. So I was on a call earlier today. Somebody said, oh, I hope we can do this. I said, well, hope's not a strategy. right? That's just not going to work. Some folks approach is, well, I'll just get another credit card. If I've maxed out this one, I'll just get another one. Playing the lottery, or borrowing to get by. I'll just make a note on the lottery here. How often you've been stuck behind somebody when you're buying your coffee and they're buying, $30 or $40 worth of scratch off cards. When I teach financial literacy to just about anybody, I always want to point out that you got to check the New Jersey Lottery website before you buy a scratch off ticket, because there's a pretty good chance that the ticket you just bought, you cannot win, because the biggest prize has already been given away. They sell those tickets until they're gone. So if you buy a ticket that's got a $2 million prize, check to make sure the $2 million prize is still available. Otherwise, you're just wasting your money. Sure, there's $5 and $1 and $7 winnings, but that's not why you're buying tickets. So what is a spending plan, right? So it's essentially, it's a snapshot, right? A point in time look at what's going on as far as how much money is coming in versus how much money is going out, right? We want to look at it that it's a planning document. I look at it as a living and breathing and ever evolving document, right? As to what's coming up, right? So it's not like we establish that spending plan on January 1st and that's it. We've got to continue to look at it and to massage it and to make sure that we're making adjustments, right? So because things change, right? I've noticed in the last 3 or 4 weeks, the price of gasoline has gone up significantly. So if you drive a lot, well, now your gas budget, right, to use the B word, right, your spending on gasoline is going to go up quite a bit, right? We're worried about grocery prices. Those kinds of things. If interest rates change and you're carrying a balance on your credit card, it's possible that your credit card company will raise your interest rate, right? You've got to keep those things in mind, and so you've got to adjust your spending plan to keep up with that. So that's your really, when we think about our first step, it's let's come up with what is our plan, right? So we use a document that looks something like this. You can build your own, use a spreadsheet, and really spend some time on it to think about the top part. Now, I'm looking over here. I have 2 screens going on, so I'm not looking out the window. So the bigger screen is over here. So we've got that sources of income, right? So we've got our primary job. If we have a spouse or somebody else that's also contributing to the household, if we've got some part-time work, if you've got some other source of income that's coming in, maybe it's parental support or ex-spouse or whatever it is, we want to make sure we take into consideration what that is. If there's any investment income, if grandma's is slipping you, $10 a month, that's fantastic. So we want to make sure that we're accounting for all that income that's coming in, right? Then we turn around and we look at our expenses, right? So you can look at expenses in 2 ways, right? There's fixed and then there's variable, right? So fixed expenses are the ones that don't change, right? So your rent, your housing payment, whether it's a mortgage, your utilities, fixed to the extent that oftentimes you can set up what they call again, they use the B word, the budget plan, where you have the same payment every month. So it's easier to fit into your cash flow. So our utilities are more or less fixed as an expense from that standpoint. Our insurance costs, our auto insurance costs, our health insurance, those kinds of things. If you have loans, repayments are typically a fixed in amount for the year or for the duration of the loan. Then we have variable costs, right? Food costs, grocery costs, right? Times of year when it's the holiday period in my house, I'm the cook in my house, I spend a lot more money because we're cooking a lot more. In normal times, we may be entertaining. We'd have folks coming over the house, so maybe we cook a special meal or have some special things in the house. We've got to plan for that going forward. So food can be a variable. Clothing, right? How much money do we spend, right? So we're all work on top and party on the bottom today, right? Well, what happens if that changes and we've got to be work all the way through, right? Are we going to have to add some more clothing to fit our new work on the bottom sizes, right? So variable credit card charges. I think of credit card charges. I typically don't like to put a line item in when I look at a spending plan for credit card charges, because we're using the credit card for one of these other items, right? We're buying food, we're buying clothing. So if I'm using my credit card to buy food, which in my house I do, I don't create a separate line item for credit card charges. So I would avoid that if I were you. I would just say, oh, I spend this much at the grocery store. It doesn't matter how I get the money to the grocery store, right? I can take cash out of my pocket or I can use my credit card. as long as I pay it back at the end of the month, but it's still the same amount of money that's being spent on food. You have transportation costs, right? If you commute, public transportation, that kind of stuff, tolls, parking, things like that would come under your transportation line. Leisure, right? If you're having any fun at all, right, that may be under leisure, right? So maybe that's your Netflix. If you're one of those people that has your own account, right? Because everybody's using the same user and password from the way I understand it. But if you have your own Netflix account, that might be a leisure expenditure, right? If you're going to travel, if you're going to, if you do things for leisure, there's also the travel budget. Obviously, this year, last year, and probably most of this year, that travel budget is going to be pretty low. Next year, or later this year, next year, let's hope that travel budget or line item is expanded quite a bit. Taxes is an interesting thing to put on our spending plan here, because a lot of folks that I talk to, especially that don't have a lot of experience paying income taxes or doing tax returns, they look at how much is withheld from their paycheck and they say, oh, that's my tax amount. And I just want to point out that that's not actually true. The US tax system is what we call a pay-as-you-go system. So we're supposed to pay in as we go along throughout the year. As we get income in, it's taxed. We're supposed to send some of that money in to the IRS in anticipation of what our total tax will be for the year. And so relying on whatever the payroll department withholds from your paycheck as your tax payment, probably not the best thing, because they don't know anything about the rest of your financial situation. So oftentimes it's a good, what I suggest to folks is, how much did you pay in taxes last year? Or how much was your actual tax bill? And let's make sure that by the end of this year, we pay in at least that much amount. I don't like to pay in too much, right? I know a lot of folks I have a call with a client tomorrow afternoon. She had to pay this year. She's unhappy. She said, oh, we like to get a big refund. So my conversation with her tomorrow will be, well, how much money are you willing to loan to the government with zero interest? And I know the answer is going to be zero. I said, okay, good. Then let's not change your withholding. Let's leave it the way it is. I would much rather owe them a couple $100 than to be getting thousands of dollars back. Because after all, how did that money get to the IRS? Well, they took it out of your paycheck every pay period, right? It's not a windfall. They're just giving you back your own money. So let's think from that standpoint. Then we've got this whole miscellaneous category. Again, not a big fan of the miscellaneous category. I understand that there is miscellaneous expenses. In my cash flow, we have a miscellaneous category, but I don't like to lump a lot of things together. I like the specificity of lots of rows in my cash flow plan. And so then we've got a simple calculation, right? So we had total money that came in at the top versus all the money that went out on the bottom, right? The income minus expenses gives us whether we have a spending plan surplus or a shortfall, right?
Hey, Tom, I'd like to just jump in real quick
Sure, go
here.
ahead, please, Diane.
I agree with you that we do like to see more specificity. I mean, for myself, it helps seeing more specificity, like, is it personal care? Because I find the more specific you are, if you do need to make cuts from something, you're not going to be able to make it from your fixed expenses. So that's really where your values will line up, and you'll start to say, like, no, I could cut food or whatnot. So that's one comment I wanted to make. And the other that this does not have on this budget worksheet that I feel is important is there's not a line item for savings. Right. So I'd like you to keep conscious of, like, just getting into good money habits from the get-go and always paying yourself first. So that's all I wanted to add. Thank you.
No, that's spot on, Diana. And you point out something, I'll keep using myself as an example. In our household spending plan, there is a line item for Tom's haircuts, Christy's my wife, her haircuts. When we had a dog, there was a line item for the dog's haircuts. Funny thing, the dog's haircuts cost more than mine. Go figure, right? So the specificity, as Diane points out, really important so that we can actually see what we're spending. So in my budget or cash flow in my house, there's a clothing line item for me. There's a clothing line item for my wife. we have an allowance line item, one for me, one for my wife. So we can actually see, and we'll meet on a more or less quarterly basis. There may be a glass or two of wine involved, and we'll go over our expenses, especially the food expenses. I don't know if I mentioned, I'm the cook in my house, and I like to cook, and I'm fairly good at it. So I like good ingredients, and I often cook way more than we need. So oftentimes that our grocery bill, and actually our food bill, is split into groceries and eating out, which now is replaced by ordering in, because that oftentimes that's a huge source of expense that we really don't even pay attention to. So exactly right,
That's an
Diane.
awesome point. That takeout
Specificity.
is,
Yeah,
yeah,
that takeout, that'll bankrupt you.
it's a killer.
It really is. So we even have a line item for alcohol, believe it or not. That's how crazy we are in our house. Now, I can't say that our spending plan is always positive. In other words, that the bottom line here says budget surplus or shortfall. I'm not going to go on record here and say that ours is always a positive or always a surplus. It almost never is. But what it does is all those line items going down the list, especially when it shows my spending versus her spending, it shows us where we need to make adjustments. I'll say that again. Having that specificity gives us the ability to make adjustments. You'll notice the two columns to the right here on spending plan, percentage reduction or amount saved, right? That's where we need to do self-correction. When I meet with a new client, this is often the most difficult part of the entire process, is to come up with how much money they spend. And they get nervous. They say, "Oh, Tom, you're going to put me on a budget," which I would never do. It's not up to me to tell people how much money to spend on groceries or wine or whatever. My job is to help them figure out, how much are you spending on wine and ordering in and magazine subscriptions? Or one time I did a seminar similar to this for the military, and there was a gentleman there. He spent a ton of money on fishing equipment, right? Fishing lures, fishing string. So I don't know how many fishing poles can you use at one time. This guy and the wife gave him a big elbow when I mentioned fishing supplies, because he was spending a fortune on fishing supplies. So it's good to know what that is, right? In our house, we like growlers of fresh made beer, right? So we probably should have a line item for that. But so the idea of specificity, so that we can make adjustments, right? The adjustments that we recognize, yeah, I could do better in this area. So that's why that's really important. I didn't mean to spend so much time on this thing, but it is one of the most important things. And in my opinion, it's foundational to being financially successful, because you have to understand how much money is coming in versus how much money is going out. Okay, so that's really important. So Janet, do we have any questions on cash flow just yet?
We did seem to have a question on apps that people could use.
Yeah, a budgeting app.
Sure. So there's a bunch out there. I'm not up to date on all the ones that are out there. I know they're out there. I know they're, we are in an app economy or an app ecosystem.
I think we should hear from Justin on this one.
Yeah, if it's a tool that can help you track, plan, and adjust, I'm all for it. Justin, what do you think? Is there anything that you've come across that is particularly helpful in the app space?
Yeah, I put some comments in the chat so they could have it.
Great.
We got some good feedback from Mint as well. I know some clients that have successfully used YNAB. You need a budget.
Yep.
And then there's also one called Every Dollar as well. It has a free version and a paid version, so you can start with the free version, see if you like it, and then upgrade if you really find it helpful. But the important thing is to just find something that works for you and that you're comfortable with. Right,
and that's helpful, and that you'll stick with. I was an early adopter of Mint. I haven't used it in years, but I was one of the first few people that used it early on. I thought it was a good idea. At the time, the problem that I had was I couldn't, and this is gonna tell you how old I am, I couldn't print out a report so that when we sat down, my wife and I, to go over it, there was nothing that we could hold in our hands and put our wine glass on. So that was a problem for us. So that was the only down for today. That shouldn't be a problem for anybody. We've also, over the years, we have used Quicken, which is a software program that's really more of a personal finance software. That's been helpful. We still use that. I use Quicken for business for my business accounts. So that is certainly helpful. I will point out that as Justin pointed out, there's a free version. Keep in mind that if it's free, they're going to serve you all kinds of ads, and read the user agreement, because there'll be information sharing going on. So just be cognizant of that. That's, if they're willing to give it to you for free, it's because somebody else is paying them to help them do that. Nobody that I know works for free. So just keep that in mind. So again, we have sources of income. We mentioned that the top line, I'm not going to go through this line by line, but right. So we have our income, our spouse's income. If somebody else is helping out, if you're renting rooms out to folks, or there's some other type of income coming in, we got to keep that in mind. We mentioned all the fixed and variable expenses, right? So we've got to do the math, right? So you've got to get the data from somewhere, right? So there's an old technology rule, garbage in, garbage out. So make sure you've got good information, right? Some of your pay stubs, you may need to print out the check register if you do online banking. If you use an old-fashioned handwritten checkbook, then you'll need the register. I believe many banks today will actually print out a report and categorize your spending for you. I know Quicken does that for me. You may need your credit card statements, if not your receipts. Then you've got to make sure that you've categorized everything correctly, and be consistent. Don't make it too difficult, right? Because if it's too difficult, we won't do it. But make sure that we've got everything that's designed to a specific category, and then you do the addition and subtraction. So some of the things to take control and some remedies, right? Because like I said, that bottom line isn't always going to be in surplus. A lot of times, if not all the time, it's going to be in deficit, right? So we're spending more than we take in. And if you think about it, how are we doing that, right? How do we deficit spend on a personal basis? Well, it's the Capital One card, right? It's our credit card. That's what allows us that buffer so that we can spend more money than was got deposited into our banking account. So we've got to be careful there. So what are some of the things that we can do? So we can try to increase our income, right? Should we be looking for a higher paying job? Should we reassess? And for those of you that haven't started yet, think about that in the negotiations phase. Can you negotiate a higher income, right? Maybe there's some part-time work. Certainly, obviously with COVID, it's a little difficult to do all that. But then we look at, the adjustments to our expenses, right? Reducing the extras. This is where the specificity that Diane and I, that we think is so important, is so that we can reduce those extras. Control the essential costs, right? So making sure that we're not, maybe our cell phone or our data plan is more than we need, right? So maybe that's an adjustment that we need. Maybe we can decide that we don't need to get the latest version of the new smartphone that's out. Maybe we can wait a version or two and still have the same functionality, right? So these are the things that we could look at. So which path is more realistic? I would say pursue both. Obviously, trimming our expenses is typically the more realistic one, right? So we look to cut out some avoidable expenses. We can look at some of the things that we can do there. And
guys, I just want to point out that those, that's all the fun stuff usually, right? So
I didn't want to say that.
I know, but you have to be reality based.
Right. Or maybe there's less expensive ways.
Right. There's alternatives,
to do
right?
those things.
Yeah. You go on a hike or yeah.
There's a question about how much time you spend doing your monthly calculations, and can the bank send like an Excel or CSV file that then helps you put it into, categorize it, or do you do that manually?
That's a great question, and I'm glad they brought it up. So in my house, as I said, we use Quicken, so we can download all the transactions from our credit card, and or our bank statement. Now, the credit card statement, typically everything, the Quicken can recognize what that charge is from, whether it came from the, the gas station or the grocery store or the utility company. It typically can recognize that if we write an old-fashioned check. So the lady who comes to clean the house, she gets a written check. There's no way for Quicken to know what that is, but it knows what the amount is. So we've got to go in there and manually change that or correct that. If you take money out of an ATM and use cash because you use cash at the laundromat or something like that, you have to categorize those things manually. How much time should you spend? I think you should spend enough time that your data is correct, your input is correct, and that your output is usable. I think that's important. So being if it's a weekly activity, right? So it's on Saturday afternoons that we sit down and we go through all of our stuff to make sure that our numbers are accurate. That makes perfect sense. If you do it on a constant or a repeating basis, it gets to be really easy, right? Because let's face it, there's only a certain number, hopefully, there's only a certain number of transactions that could have happened in the past 7 to 10 days. Right. So, and if some of those are recurring payments, we mentioned that your utilities are often the same number. Well, again, if you're using one of the apps or software like Quicken, then those should recur. The software Quicken actually will learn that those are recurring, and it will categorize those correctly. So it shouldn't take you a ridiculous amount of time. Once you get it set up, once you get your category set up, and you get comfortable and familiar with using the tools. So let's see, the third thing is plan for lower fixed. So the steps here are, cutting out avoidable expenses, reducing the variable spending, right? So they put all the cookies and the gum and all that kind of stuff up near the checkout counter for a reason, right? Because those are the impulse purchases. So we got to be careful for that, and then plan for some way to lower our fixed costs, whether that's, lowering our rent, lowering our utilities, like I said, your cell phone plan or your data plan, maybe you're on the wrong plan. These are all kinds of things that we can do, right? So we look at all these kinds of things. My wife and I, we would do an audit of all the expenses, and my wife's much more diligent than I am, but she would go after the cable company, and she would go out and say, "Oh, my God, you're killing me. We've got to cut our costs." So oh, there's nothing I can do. Let me speak to your supervisor. Next thing you know, we're getting a reduction of $50 a month. All you have to do is ask, and the worst thing they can do is say no. So that's something that we can do. Avoidable expenses. They mentioned credit monitoring services. I'd be careful here. You don't necessarily need monitoring services. From my experience, most of them, they will tell you after something has happened, which is akin to, shutting the door after the dog got out. Doesn't help you very much. So I wouldn't necessarily pay for credit monitoring services. What I would do is I would make sure I check my credit report at least once a year. So there's 3 credit bureaus. I would just go to each one of them at a different time during the year and get my credit report and make sure there's nothing on there that shouldn't be. But having a monitoring service, I don't, unless you've had problems in the past. If you've had identity theft or your credit's been accessed before, then it might be a good idea. But if you haven't had any of those kinds of problems, that's something I think that's an expense you can do away with. If you notice that you've got a lot of late fees or over your limit fees, we've got to figure out how do you limit that. Right? You've got to do a better job. You've got to be more proactive in making sure you're making your payments on time, and making sure you've got the proper cash in your accounts. So again, look at your variable expenses, right? So food and clothing. Maybe there's the less expensive way for you to go to work. Not that anybody drives to work anymore, right? So get better at cooking. These kinds of things. So
Tom, you got to start cooking some more chuck instead of that filet mignon.
Yeah, exactly. A lot more chopped meat in my house. So well, it's funny because at the beginning of every winter, I cook a ton of stuff, and I have a freezer. I have a full freezer that is filled with quart containers of soup and stew, chicken soup, chili, all that kind of stuff. So I just got to throw that in a crock pot when I leave the house, set it on a timer, and we have dinner when we get home. That way we're not like getting home and pulling out all the menus to say, okay, who are we ordering from tonight? I don't have to, because I know I've got something that's reasonably good in the crock pot. So that's how that works. That's the
Yeah, and
whole
it
point.
kind of, I think, comes down to like really being intentional. And like Tom said, find something that you can repeat. Like, for me, it's Sunday mornings, but, somewhere where you can just take a moment for yourself and just think the week through. And, sometimes just taking a half hour to figure out, okay, I know I'm going to be working late on these days. And, so I want to make sure I make something with enough leftovers, or, looking at what's on sale maybe at the store, and figuring out a menu around it. So I think it's just, just find, 15, 20 minutes a week to kind of think through.
Absolutely. And it certainly, it can help you be healthier as well, right? Because now you can actually plan your meals and you can plan better meals. So that's helpful as well. So, there's some math here. I'm not going to bore you with the math, but obviously, if you spent $7 a day on lunch and you did that 5 days a week, you'd spend $1,750 over the course of a year, assuming you took 2 weeks off. If you could cut that down to 3 days or even 1 day a week, that you cut your cost down to practically nothing. We're not saying don't enjoy yourself. We're not saying you can't go out to eat, you can't get a sandwich every now and again, but just understand that there is a cost to that, right? So when we see that someone spends money that again, I don't tell people how to spend their money, but when I see that they're spending money that I know that they could avoid spending, it gets a little bit difficult. So I think about folks that smoke. Right? You say, okay, well, I don't even know how much cigarettes cost today. I'm pretty sure it's more than $7 a day, but that's one of the easiest ways to save a ton of money today and into the future. So let's see what do we have here? A couple more slides. Lowering our housing costs. That's pretty self-explanatory. Cheaper insurance, so auto insurance, right? I believe there's a couple commercials on TV that'll tell you how to lower your auto insurance if need be. You've got to make some decisions. I don't wish this on anybody, but it sucks being a grown-up. We've got to make some choices. Sometimes looking at whether or not we use our credit cards all the time. I look at credit card as a tool. It's a way for me to transfer money from my pocket to the store's pocket without carrying a wad of cash around me. It's not a method. It's not a tool that gives me an extra, $5,000 or $7,000 or $10,000 to spend, right? If I have a $10,000 spending limit on my credit card, that doesn't mean I have an extra 10,000. It just means that I have a tool that will allow me to transfer money from my pocket to the merchant's pocket without carrying cash. That's all it is. It's not.
So then, Tom, do you advocate using a debit card rather than a credit card if you are afraid of running up your credit limit?
It comes, not necessarily. No, I that makes me a little bit nervous. I try to, in my life, I try to time out when I make payments. So I'm a wait till the last minute kind of guy. So if I have a credit card bill, and we use credit cards almost exclusively in our house. Most people don't want to handle cash with the pandemic, right? So using the credit card, as long as I know that it's spending that I've planned for anyway. So go all the way back to page 3, right, where we had our spending plan. So if I know how much my grocery bill is for the year, I don't have any problem using my credit card to make that payment. What makes me nervous about using a debit card or an ATM card is that if I go off the deep end and I spend more than I planned on, and now I have less money for something else down later in the month, now I got a big problem. So the credit card kind of gives us that 30 days of grace, so to speak. So I prefer a credit card. Not everybody does. But the idea is that we've got to make sure that the spending we're doing is spending that we planned for. Okay, and that third bullet there, fight impulse, right? Fight the impulse buying. That's a big thing right there, right? So we want to fight the impulse buying, right? So it's on sale. Not if you didn't need it. There's no reason to buy it if you didn't need it. Yeah, but it was on sale. No. That's not a good reason, right? So we've got to make sure that we're looking at that, evaluating the cost of hobbies. I'm not a big fan of this word either, but hey, if that's what it takes to get to so that we can not have to ration our entertainment sometime later on, then I'm fine with that. Debt, I think Justin's going to talk a little bit more about debt, so I'm not going to spend a lot of time at all, other than, there's multiple ways to work on paying down debt, and really should educate yourself and figure out what's important. I will point out here, as far as pay more than the minimum, right? So when I teach the credit card class, so I teach financial literacy to freshman undergrads. And so I always tell them, if you're going to use a credit card, you've got to pay on time and you've got to pay in full, right? If you're unable to pay in full, absolutely pay the minimum and make sure you pay it on time, right? Those two things are the biggest issues that we see that affect your credit score, is paying on time and paying at least the minimum, right? So never skip a payment, and certainly don't pay late if you can avoid it. Those are two credit killers. And this is what Diane was mentioning earlier on, was to include savings in your spending plan, right? You should make your savings allocations high up in that expense category, right? Pay yourself first, make sure you're putting that money away. Having an emergency fund is very important, right? In case there is an emergency, in case the car breaks down, or you've got to make a change to your living arrangement, a health issue, who knows?
Maybe there's a pandemic.
There's a pandemic, right? So yeah, having an emergency fund is huge. When I teach my undergrads this, the whole idea is, you want to have at least 3 months of your committed expenses. So those fixed expenses that we had up on top, your rent, your insurance, some of your loan payments, perhaps food, those are fixed expenses. The rule of thumb had been at least 3 months, preferably 6. I know people that have much longer than that. And I would think after this pandemic, you're going to have folks that are going to have, a ton more of emergency fund set aside, because who knows, oh my God, who knows when and if this will ever happen again. So let's see, what do we've got? We've got the recap, right? So you've got to get good data. You got to do a good job of analyzing your data, make adjustments where possible. You want to make sure that you're not spending more than you have, right? That's where the alignment of income and expenses, right? Include savings as part of the budget. That's the Diane rule. And then monitor and modify periodically. I would suggest, especially if you're new to this, don't drive yourself nuts, but maybe you do this every 10 days, every 2 weeks, till you get familiar, and you start to see small victories, right? Oh, I plan on spending this much at the grocery store. I spend $15 less than that. And if you don't use coupons, please do. I've been using coupons all my life. My biggest haul on coupons, I think, was $75 at BJ's Wholesale Club. So just use the coupons. If somebody wants to give you money, take it in the grocery store. So I think that's my last slide here.
I'd like to jump in real quick.
Go ahead, Diane.
A few comments. One of the things that really helped me when I developed a spending plan is like looking at it year over year. Because what can happen, especially as you all are, graduating and starting new careers or whatnot, sometimes lifestyle creep can start to set in. And what I mean is, there's a little extra cash flow, and maybe you start spending money on things that you hadn't spent before. And for myself, when I'm working with clients, a guiding principle for me is, if someone is not at goal, they need to keep saving to get to goal. And, people in your generation have come to realize, which my generation didn't. My generation felt like you had to work until you reached a certain age and then you could retire. And what's inspiring to me is that a lot more people know that they want to get to a point where work becomes optional, right? Where they can make the choices of, starting a new career, or starting a new business or something. And, and unless you, build the savings in, and there was a question here, is there like a certain percentage you should strive to get to save each year as a percentage of your income? 10% would be a great number, 15% even better. So obviously, the more you can start saving at an earlier time, with the compounding of returns and whatnot, you're going to just be in that much better shape.
That's a great point, Diane. As far as the amount to save, and there was a comment in the chat I was able to open up. How much do you save? I think the goal is to start at 10%. If you can start at 15%, it's even better. Think of it this way, especially if you're someone who's about to start a new job, a new career, a new source of income. If you start out saving 15% right off the top, and then arrange your spending plan with everything that's left over, you're going to be in great shape as long as you don't ever give up on that give away some of that 15%. Because think of it, if you say, oh, and I've had students that will tell me this, they'll say, oh, I've been working my, off all my career in school. I'm going to go out and get a job. They're going to pay me well. I'm going to enjoy myself. I'm going to spend everything. And I say, okay, that sounds like fun, but think of it like this. In about, I don't know, 7, 8, 9, 10 years from now, where will you be in your life? Chances are you'll be married. There might be some kids. You might be looking at your own mortality and realizing, oh crap, I should have been saving for buying a house, for my kids' college education, for a retirement. And so at that point, let's say you're 10 years in, now you've got to go back to that spending plan sheet that we had at the beginning of the presentation. And well, we said early on that we're always in a deficit, right? Because the credit card allows us to spend a little bit more than we take in. So first of all, you got to get yourself to break even. Let's say that's 5% down. And now you've got to save at least 15% because you've waited so long, right? So down 5% to get to break even, and you have to save 15%. That's a 20% reduction in your standard of living. I don't know anybody that can reduce their standard of living by 20% on the turn of a dime. So getting used to saving that amount, that 10 or 15% from day one, crucial to long-term success. Don't wait 10 years to try to do that.
Yeah, what I'd like to say is, for some people, like that's the ideal, but maybe that's not doable in the beginning. Number one, I would encourage you, for whatever job you have, to see if they have a retirement plan, because quite often, whether, I think Janet mentioned there's going to be a 403B conference or something. I'm not sure. Is there a match? Is there something where you're working where the retirement plan has a match? So you want to make sure that you are putting in enough so that the company will put in and match what you're putting in. So that, if you think about it, is 100% return, right? If you're putting in 3% of your salary and the company's going to match 3%, well, even if you stuck it in cash, you've in essence doubled your money.
Doubled your money.
Yeah. So for those that, maybe that they can't start with that big percent, what I like to encourage is each year to revisit it. So if you start out and, even if it's 1%, you started. And sometimes that's the biggest hurdle, is making the first step. So then maybe next year you increase it to 2% of your salary, or you increase it, whatever, and each year, if you try to incrementally increase it, before you know it, you'll get to that point.
There's a real easy way that I've suggested, and I've done this with my own daughter, right, is that when she gets a raise, so let's say she gets and she got very lucky this year, she got a 5% raise. So let's say out of that 5% raise, she adds 2.5%, basically half of the raise goes into her retirement plan. She gets to keep the other 2.5%, right? So she didn't, I say we, right? She's 27 years old. How much control could I possibly have? But she was able to double or increase her savings by half of whatever her raise was, plus her spendable income went up by roughly 2.5%. So it wasn't like she wasn't rewarded for all the hard work last year. She was able to enjoy some of the raise, but also send some of that raise on ahead through her retirement plan. So think about it. Every time you get a raise, you say, okay, I'm going to take half of that, put in my retirement plan. The other half I'm going to take home, or any combination thereof, right? That way you enjoy it and you send it on ahead. So that's a great way to get started. I know somebody had mentioned, 1%. Justin suggested 1%. That's great. Next year when you get a raise, split the raise. Take half home, put half in your retirement plan, and as Diane said, before you know it, you'll be saving the max. That's a great way to start. So I want to turn this over to Justin. Justin's going to talk to us a little bit about credit. And so I'm going to stop the share. And I think, Justin, you should have the ability to climb in there, and we'll keep looking at your questions. Thanks, everybody.
Thank you,
All
Tom.
right.
And just to Angela's question about, how to invest that savings. If we don't have time to talk about it today, I'll just put in a little plug that on April 20th at 4 o'clock from 4 to 5 p.m., we're going to have a whole session about, mutual funds and 401ks and 403bs and things like that. So it's kind of a follow-up to today.
Very good. All right. So I'll take over here and I'll talk about kind of debt, how to eliminate that, and specifically also go over student loans and how we can, best attack those. So look, when you're looking at debt, you want to prioritize the debt so that you are eliminating it in the proper order. And what I mean by that is whenever you have a higher interest rate debt, you're going to want to eliminate that first. So that includes those credit cards, any personal unsecured loans. Those are normally at a very high debt. So if you look at the credit cards, you read the statement, it's not unusual to see 18%, 20%, 22% being charged against you on interest towards those credit cards that you have outstanding. And so if we look at that, we want to eliminate those first because that's a huge gap where your money is going to flow out to. Then you want to look, if you're looking at student loans in particular, you want to look at those private student loans first because they usually have higher rates than the federally insured student loans, and they also have less built-in protections from the student loans. They don't have those income-based repayment plans. They don't have a lot of the times forgiveness of death or disability that the federal student loans have. So you want to focus in on those private student loans. And then after that, you're going to focus in on those federal student loans. If you're set up on an income-driven repayment plan, that's going to be good to go there. And then looking at that low interest rate debt, those secure loans, those mortgages, and the car notes will be the last on the list. Okay, so there's a couple different, when it comes specifically to student loans, you want to try to create a strategy, and there's very many ways that you can handle the student loans. First off, if it's federal, you've got the income-based or income-driven repayment program. So you've got the original income-based repayment, you've got income contingent repayment, which really isn't used anymore. You've got pay as you earn, and then you've got revised pay as you earn. So depending on the type of debt that you have, either from just undergrad or undergrad and graduate debt, and how much you're making can all factor into which income-driven repayment plan is going to be best for you long-term. And I'll go into some examples later on. Looking at a refinance is okay, and I go into a little bit later of when you should look to refinance, but you want to be very careful for refinancing federal loans, especially right now. Federal loans are at 0% interest and zero payment. So it really doesn't make any sense to refinance your federal student loans. But if you have private student loans, it may help to refinance to lower the interest rate there. But whenever you're looking to refinance, you have to qualify based on income and credit history. So someone that's just coming out of school or has a very low income compared to their debts that they have, it's going to have a higher percentage rate that they're going to have to pay on the refinance. And then another option for your student loans, for the federal student loans, is public service loan forgiveness. So this generally has fewer employment options with less control of your location and your pay. But the full-time, you have to have full-time employment by either a government agency or a 501c3 tax-exempt nonprofit organization, and you must make payments for 120 months, which is about 10 years. I almost said consecutive, but that's not true. So you can actually break the service apart. So if you work for a nonprofit for several years and making payments that qualify, and then you go work for a for-profit, and then you go work back to a nonprofit, you can have non-continuous, but overall it's those 120 payments. And along the way, you want to make sure that you're filling out the forms to declare that you're going for this public service loan forgiveness. So you get approval that one, your employer qualifies, because we want to make sure that, and two, that they're counting all the payments that you're making. So you're accumulating those payments. And then we also recommend that you file that once per year so that they can update the amount of payments that you made and make sure that you are still on your way towards public service loan forgiveness. And then besides once per year, you also want to do it every time you switch an employer, just to make sure that employer qualifies towards public service loan forgiveness. Here's a quick broad type of the different types of student loans. Basically, the federal loans are broken down into direct loans, the FFEL, the Federal Family Education Loans, and then there's some other loans like Perkins, primary care loans, et cetera. Really, what most of the majority of the loans that you'll have are probably the direct loans, and those are what qualify for the 0% interest and zero payment. If you have older type loans like the FFEL loans or Perkins loans, those don't qualify under the executive order, but you can make them qualify if you do a direct consolidation into a direct loan. So you can turn those FFEL loans into direct loans and have them qualify for the 0% payment and zero interest. Also to note as well, if you're going to go for public service loan forgiveness, that only works on direct loans. So your FFEL loans that you have don't qualify for public service loan forgiveness. So a lot of people thought they were on the way to public service loan forgiveness and weren't because they had the wrong type of loans. The other breakdown, but besides the direct type, you've got subsidized loans versus unsubsidized loans. So subsidized loans, the Department of Education are going to be paying that interest. So it doesn't accrue while you're in school and enrolled at least half time. And then it also doesn't accrue during the grace period, which is the first 6 months after you graduate. So if you're in a period of deferment, you don't owe interest and it doesn't accumulate if you have those subsidized loans. These are only available to undergraduates, and the school will determine the amount that you can borrow on these loans. If you flip over to the unsubsidized loans, they're a little bit less favorable because even while you're in school, the interest on those loans continues to accumulate and builds up in an interest account that will eventually that will be combined into your principal balance, and then you'll owe that at once you start repaying the loans. These are available to both undergraduates and graduates, so it's very common to have a combination of both subsidized and unsubsidized loans when we're doing a student loan analysis. When it comes to actually paying back these federal loans, you actually have two different main ways to pay. You have the balance-based repayment strategy and an income-driven repayment strategy. So the balance-based repayment is what we're normally used to when we're dealing with loans outside of federal student loans. And so if you think of, for example, a 15-year mortgage, it's going to be, your payment is going to be based on the balance of that mortgage and the interest rate, and then the 15 years. So you'll have that level payment for the entire 15 years. And at the end, it's going to be guaranteed to be paid off because that's how it was calculated. So there's really no flexibility with balance-based repayment unless you shorten or extend the time frame of repayment. So the standard default repayment for federal loans is a 10-year repayment, but it can be in certain circumstances extended towards either 25 or 30 years of level payment. So we almost turn it into a mortgage. You can also do graduated repayments where the payments start very, very low and then increase over a certain amount of time. So then they're finished paying off in 10, 25, or 30 years. But that is one of the worst ways you can pay back your loans, to do that graduated plan. That's going to cost you the most over the lifetime of the loans. What is very, very popular is over on the right side of the screen, the income-driven repayment plan. So this is where the payment is actually based on the amount of income that you earn. So it's irrespective of the amount of interest that you're being charged or the balance of the student loans that you have. It's solely based on the income that you earn. And it's always based on looking backwards on your income, or most of the default is to look backwards on your income, meaning that if you have a last filed tax return. So if you're going to file taxes in 2020, the next time you recertify your income for that income driven repayment plan, that's what they're going to base the income off of your tax return. The adjusted gross income is going to be what they base your payment on. So they're not even going to look at the loan balance or the interest rate. They don't care. It's only based on your income. And depending on the income driven repayment plan you're in, will gauge what percentage of that amount you're going to owe in terms of a monthly payment. One important note here that's highlighted on this screen is that if you're going for public service loan forgiveness, IDR is necessary. That's the only type of repayment plan that's actually going to qualify for forgiveness. Technically, the 10-year standard plan also qualifies. But if you do the math, public service loan forgiveness is after 10 years. and the balance-based repayment plan is going to be paid off in 10 years. So right when you're ready for forgiveness, the balance is paid off. So although it qualifies, you're not going to get any forgiveness anyway. So if you're going for public service loan forgiveness, the income-driven repayment plan is going to be essential for that. So here are the breakdown of the different types of the income-driven repayment plans. The two most popular that you're going to be looking at most likely is the pay-as-you-earn and the revised pay-as-you-earn. Both of them are based off of a 10% discretionary income. The biggest difference between, well, there's two big differences between pay-as-you-earn and revised pay-as-you-earn. The first is that both of these have a long-term forgiveness. So irrespective of the public service loan forgiveness, both of these repayment plans have I guess I'll call it an uncle moment, where you've been paying for so long, the federal government just says, uncle, all right, you can give up on paying these loans. We're going to forgive them. So for pay as you earn, that's after 20 years of payments. And for revised pay as you earn, it's 20 years only if you have all undergraduate loans. If you have any graduate loans, it extends all the way to 25 years. So that's a big difference there between pay as you earn and revised pay as you earn. And one more thing about that type of forgiveness, that long-term forgiveness, is that forgiveness is taxable as ordinary income in the year that the loan is forgiven. There's talks about potentially eliminating that, but under current law right now, that loan that gets forgiven, you owe taxes on that. So basically, if you get 100,000 forgiven at that time, it's like you earned 100,000 of phantom income in that year that you're going to owe taxes on. So you can owe, 25,000 or 30,000, depending on your tax rate in that year on the loan that's forgiven. Unlike public service loan forgiveness, with that forgiveness, that's completely tax-free. For pay as you earn, the other thing is and normally people use this strategy if they're going for public service loan forgiveness, is if you file your taxes separately from your spouse, you can exclude their income in the income-driven repayment calculation to lower that payment, so you qualify for more forgiveness in the future. If you don't have if you are not going to go for public service loan forgiveness, it may or may not be a good strategy to file taxes separately, because you're going to lose some tax benefits most likely from doing that. Otherwise, your payment is going to be based on the joint income between the two spouses. And then for revised pay as you earn, it doesn't matter. It's always going to be based on the joint income, even if you file separately. So there's no exclusion there. I said there was two differences. There's a lot of differences. The final difference is revised pay as you earn doesn't have a payment cap on the income-driven repayment plan. So as long as your income is going up, your payment is going to be going up. Whereas pay as you earn, that does have an income or a payment cap. Whereas once you reach a certain level of income, your payment is never going to be larger than what the standard 10-year repayment would have been. So if your income increases over to a certain point, you're going to be able to cap that out. Even though your income continues to increase, it will stop at a certain point for pay as you earn and max out at a certain point. Let's see, I can stop and take a breath here for some questions if we have them.
Justin, while you take a breath, somebody had asked me a question about the Financial Planning Association in New Jersey as to whether or not, what we are. And so essentially we are a membership organization made up of financial advisors. We are the state chapter of a national organization. And so the idea is that if you're looking for a financial advisor, we have a matching tool. It's called plannersearch.org. And so you access that page, you put in some of the requirements that you have. So if you're looking for student loan help or retirement planning or whatever it is, and you put in your geography, because the planner search is nationwide, it should match you with a list of a few advisors that you should then interview to find somebody that you would be comfortable working with. So that's the FPA. That's who we are as FPA New Jersey. I own my own firm. Justin works for a firm. Diana works for a different firm. We're all in different firms, but we volunteer with FPA New Jersey. So I hope that helps. Go ahead, Justin.
Perfect. Yeah, there's a question that just popped up too. Does FPA interact/engage with the Credit Union League?
I've been around a while, and that does not sound like something they've had interaction with.
Yeah, I don't know. I've never heard of that. So
Yeah, me either.
All right, very good. All right, let's take a second to look at public service loan forgiveness, because if any of you go and work for a university, most of the time that's going to qualify towards this public service loan forgiveness. It's the most popular type of forgiveness program. Like I said earlier, it's only available for those direct type loans. So if you have any of those older FFEL loans, you're going to have to do a direct consolidation to turn those into direct loans so that they then qualify. If you're on the path already and you do a consolidation, you want to make sure to not touch your current direct loans, because those have payments built up into them. Once you do a consolidation, you're going to lose that history of payments and have to start over from ground zero. So you don't want to do that. You only want to focus in on the FFEL loans and do a consolidation there. Then to qualify, you make those 120 payments on time while on that income-driven repayment plan, whatever one is going to be best for you. And then while working for a qualifying nonprofit, tax-free is the forgiveness, but it has a very, very high failure rate. But that can be changed by that form that I was talking about earlier, the employee certification form. And they actually just redesigned it and condensed it. So they made it pretty easy. But basically all the form says is submitting it to the federal student loan servicers saying that, hey, I am going for public service loan forgiveness. You have your employer sign off on it. You let them know who your employer is. The employer signs off on it. You submit it, and then you get a letter back saying that, yes, we have approved your payments towards public service loan forgiveness. You have 15 months of payments towards it, and whatever 105 left to go. The legislative future is unknown, so it could change. But from the momentum that I'm seeing, it's only getting more in favor of student loan borrowers, not less. So that I don't see them taking away public service loan forgiveness, but I do potentially see them expanding the service or the benefits that you can get from student loan program. I think this is the last slide.
Yuri has a question.
Okay.
For student loans, should we be paying more than the minimum / more frequently / paying while we're in school, since there's no interest currently? Can you give us some advice while there talks about student loan forgiveness legislature?
Yeah, so right now, I mean, advice is hard to give on a blanket statement. Everybody should do this, but I think the majority of people should not be paying anything on their student loans while they don't have to. The money can most likely be used better spent elsewhere, either building that starter emergency fund, paying off other higher interest credit card debt, putting aside towards retirement savings, and potentially getting an employer match. So there's a long list of items that I have ahead of paying down aggressively on the student loans, especially with the benefits that you can get through the federal student loan program. So I'm a fan of not paying, but with that said, if you don't pay and then you go spend it on beer at the bar, that's not the best strategy. So then you should pay towards your student loans. So there's always a give and take here, but I'm a fan if you have a strategy and a plan that to take advantage of the 0% interest, 0% student loan by leaving that on hold and then applying and catching up elsewhere by eliminating, high interest credit cards or savings or whatever works in your next plan. So hopefully I answered that well. The final thing is when does it make sense to refinance your loan? So federal loans, I rarely ever make sense to refinance unless you're going to pay them off very quickly. And the goal is to just reduce the interest rate as much as possible. When refied, you lose those federal student loan benefits. And you can't have income driven repayment plans. Anybody that refinanced before has lost the ability to have this 0% interest, 0% payment through the federal government, and they're still owing interest on their loans. So normally it doesn't make sense to do the federal loan to refinance those federal loans. Private loans, on the other hand, it almost always makes sense to refinance because it's not like a mortgage refinance where there's actually closing costs and everything. Normally it can be done at no cost. So anytime you can get a lower rate, you want to refinance. And especially now as rates start to tick up, if you have those private loans, you might want to look to see if you can get a better rate at this point by refinancing. It might be hard if you don't have, a lot of good credit or a high enough income compared to the debt, but it's definitely worth researching just to see if you can reduce the rate on any of your private loans that you have.
I found in my experience that it took several years of work experience in order for lenders to consider refinancing private loans without having a co-signer, What has your experience been with that?
Yeah, absolutely. Yeah. So the majority of the time, if they let you do it, they are going to require that co-signer, like a parent, to make sure that if you don't pay, that the parents will. So it's not like the federal government who gives you a a guaranteed loan with no co-signer. And the taxpayers are the backer of that loan. So if you do default and don't pay it, it's the taxpayers picking it up. Whereas these private companies don't have that benefit, so they're gonna want to make sure they get their money back. And to protect themselves, they normally do require a co-signer on those loans, which may or may not be a good option, depending on what for you it's it's fine, but for your parents it probably wouldn't recommend it if they were my client.
Kelly has a question. Does filing bankruptcy ever apply to private student loans?
So student loans are historically very, very hard to bankrupt in general. The tide is starting to turn on that though. So it's not impossible to have student loans dismissed in bankruptcy, but it is very, 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 very difficult. So if you're going to try to go the bankruptcy route, I would get a very good attorney and make sure you know what you're doing. Because if you have 100, 200, 300,000 of student loans and you try to go bankrupt, and really it's only the $2,000 credit card that you get written off, and then you still have the 300,000 of student loans, that bankruptcy really didn't do you much help. It just probably cost you money, and it cost you a ding on your credit score, and not a good situation overall.
Great.
I do just want to go through one quick illustration of a student loan showing the different repayment plans for a client that I just did this week. So let me share my screen real quick and show you. So this is kind of just raw data, so it doesn't look very pretty. But basically what this is a comparison of the different repayment strategies. So you have the different income-based repayments here, the pay-as-you-earn and the revised pay-as-you-earn. So we're going to focus in on the pay-as-you-earn and revised pay-as-you-earn because that's the decision center there, because she has a relatively low income compared to the amount of student debt that she has, and the total is $305,000. The average interest rate is 6.16%. But when she just comes out, her payment is actually was zero, because what I had advised her to do was to file a tax return before she graduated school, so that when they created that first income-driven repayment plan, they have a zero repayment for those first 12 months until she recertifies her income. And then what we can look at is that long-term forgiveness. And so what I did here was I illustrated her income slowly increasing all the way up to 150,000 and then just increasing by inflation. So if you compare the pay-as-you-earn and revised pay-as-you-earn over the next 19 years, she's going to pay about $300,000 over those monthly payments over those next 19 years. If she's in revised pay-as-you-earn, since she does have graduate school debt, it's 5 years longer of the repayment. So she's going to repay more at $429,530. And so if you do the quick math here, so she's only paid $300,000, but she started with 305. There's definitely going to be some left over. So it just turns out that she basically paid the interest most of the time. So the principal forgiven at that time is going to be 305,766 plus additional unpaid interest forgiven as well of 44,000. So basically she paid 300,000 and gets $350,000 forgiven, but she also has to factor in the taxes on that forgiveness. She lives out in California, so taxes are going to be quite high. So I just did taxes at 40%, so it might even be more than that. But basically, she has to prepare in 19 years for $140,000 tax bill out of pocket. But basically, if you compare this way to what you would plan to do by just paying off the loans aggressively, what you'll find out is this way is a better way to go financially, and for building wealth, because you'll pay less overall with this strategy than you will. But once she can't pay it off in 10 years, she can't afford the 10-year repayment plan. So that's not even an option. But once she can afford a bigger and bigger payment, the interest is going to be so built up that that's going to be more out of pocket than just waiting and going for the forgiveness. And then we also created a payment strategy as well. So basically, you can see the effective interest rate on that is only 2.32%, even though the average interest rate was 6.16%, because it's factoring in that forgiveness. And then we
Hey,
create.
Justin,
Yeah,
can I jump in there for a second?
sure.
So it's a fantastic illustration. I just want to point out to folks, you mentioned the tax. And so, that's often a surprise to so many people, that loan forgiveness is a taxable event. And so essentially the amount that's forgiven is considered an income item. Even though you don't actually get the money, it's as if you did. And so you would have to figure that on your federal tax and presumably on your state income tax return for the year that it was forgiven. And so what Justin's pointing out is that, yeah, this is a great strategy, but we have to make sure that we allow for, or just make sure that we understand that there's going to be a tax bill for the tax year that the loan is forgiven. That's everything else is fantastic. Great presentation. I love the way you give all those options there.
Yep, perfect. And then this is actually the strategy to pay the tax bill. And so she probably can't afford the $458 per month, but if she was able to save that over the 19-year period at a 3% interest rate, she would be able to have that $140 to pay on the taxes. So what we'll most likely do is save as much as she can now and slowly build that savings over time, so we can be prepared for this this tax bomb at the end of the journey.
And the taxes is not a reason to not do this, folks. It's not a reason, right? We'll figure the tax out in 20 years. Don't worry. Do make sure you're looking at this.
So that's all I've got. Do we
There
have any
was,
other
I know at
questions?
the beginning, there was somebody who wanted to touch upon,
The target date funds I saw.
yeah.
Yeah. I mean, they can probably cover that more in the 403B seminar to know exactly what type of target date funds that are available in the plan that you have. But in general, I'm a big fan of target date fund, especially when you're starting out, because that's really putting it on autopilot. And then as you get a bigger balance, you want to go in there and potentially fine tune it. But all a target date fund is, and how you select one, is normally it'll say whatever the sponsor is, so either Vanguard or American Funds or whatever. And then it'll say a year. So it'll say 2055, 2060, 2065. So that year is the year that you plan around your retirement. So around 65 or 60, whenever you plan around retirement, you match it up with that year. And what it's going to do is it's automatically going to give you a fully diversified portfolio that starts relatively aggressive while you're younger. And then slowly, as you start to get to that target date, rein in the aggressiveness, introduce more fixed income into the portfolio, so that when you go to retire, you're not subject to large amounts of market risk at that time, where you're okay with taking that when you're younger and just starting, whereas you don't want that in the later years when you're getting ready to retire. So it's kind of an autopilot way of investing, which is not a bad option. It's better than letting it sit in like just a bank account or whatever, or money market account earning very, very low interest.
Thank you. Any other questions, guys? We have these three experts here to, when target date fund rebalance themselves in 401ks, do we get taxed?
No. So a 401k is a tax deferred vehicle. So even if you go out of the target date fund and into a completely different fund, or there's rebalancing or dividends or interest that gets paid out of those funds, it's completely tax deferred. You get taxed, assuming that it's traditional and you got a tax savings on the way in, you're going to get taxed on the way out when you take it out in retirement. But while it's in the account, it's tax deferred. So you're not owed taxes at any point in time until you actually remove the funds from the account.
I see someone had a question with regard to, should they have different accounts for different goals? And I would say that depends. I would think that you would want to have accounts that line up in time horizon, right? So there might be some goal that is, far away, like retirement, that you might take a different risk exposure as to market volatility and whatnot. So, for a goal that might be, 2 years off, you might want to have an account that's, like a cash alternative, something that is safe. I don't know if Justin or Tom, you have other comments on that you want to add.
That makes perfect sense to me. I mean, for some people, again, it's the way your brain sees it, right? And so having different accounts that have for different time frames different goals. That makes perfect sense. I would hesitate to not have too many. I did have a prospect one time. He came in, and he was a retired or retiring banker, and he had about a dozen different actual savings accounts that he was putting money in every month for different goals.
Yeah.
And it made perfect sense, but it was a lot. It was a lot to manage. It was a lot to keep track of. Certainly at tax time, there was a lot of stuff going on. So like we said earlier, we're big fans of specificity, but let's not get crazy, right? let's make sure that we can do it, that
You
it's
want it to be
effective.
manageable. Yeah.
Yeah, manageable, exactly.
Yeah, the way I approach it is actually to think of it almost as like a ladder. So you've got the checking account where the money's going to flow in, money's going to flow out. Only the names are changed to protect the innocent kind of deal. And then you keep a very relatively low balance in there just to make sure that you don't overdraft on it if you have a big expense. But then above and beyond that, you graduate to a savings account. And that's where you're going to keep like 3 to 6 months of expenses in an ideal world, where you're only going to tap into that should you, have a major emergency where you're going to have to pull from that, and then you want to refill that really quickly. Then that's
the emergency fund that we mentioned earlier.
Yep, the emergency fund there. So you have your checking account, then that savings account, that emergency fund. So you want to try to, I would say, maximize the interest on that, but that's a secondary concern. So for example, I use an online savings account and get a whopping 0.5% for my emergency fund. So the rate of return is nice to try to maximize, but that's secondary compared to the liquidity and the safety of that. So you want to make sure it's FDIC insured, and you want to make sure you have relatively quick access to it should you need it in a short amount of time. And then after you graduate from that, then you want to look towards those intermediate term goals, saving for a house, saving for a car, saving for whatever goal you have probably within the next 2 to 7 years, I'll say. And then after that, you have your longer term goals like retirement or vacation home or whatever. So if you just have those general ideas, that's a good way to lay it out rather than having a separate account for every goal. You just have your short-term checking, emergency fund, then intermediate, and then long-term.
Right.
That makes sense.
Don't forget college education for your children.
That is true too.
Hey, I'm going to bring something up. There was a question about whether or not we interface with another organization, but I'll throw it out there. The FPA New Jersey, we are a membership organization. We're all volunteers. We have a huge commitment to providing financial literacy and teaching financial literacy. So if you have another group or organization that would benefit from a presentation like we've done today, please don't hesitate to get in touch with us. We'd be happy to do that. We love to hear ourselves talk, especially if whatever we're saying might be helpful to somebody, right? Because I explain it like it's good karma, and I need all the help I can get in the good karma area. But certainly, if somebody needs this in another organization, we're happy to help.
So you give these talks for free, but do you give financial advice on an individual basis for free?
Not through the FPA. So, and I was trying to answer this in the chat with a couple of folks. I pointed out plannersearch.org, which is the national website for the Financial Planning Association. And so the Planner Search, you go on there and say, I need somebody to help me with my student loan, whatever. And I want somebody that's in New Jersey. So you put your zip code in there. And so Justin and whoever else works in that area, their names and contact information should pop up. If you're somebody that's looking for retirement decisions coming up soon, you'll find me, and I think you'll find Diane as well, depending on from a geography standpoint. Now, with the pandemic, we can all work remotely. Like this is the way I do my client meetings now. I'm pretty sure everybody does, but we all have different ways to charge fees. And on the Planner Search website, there's some pretty good discussions about how financial advisors might charge. The link that I put in there on what questions to ask a financial advisor, chief among them is, how are you paid? What are your financial, what's your background? What's your training? What's your licensing? All that kind of stuff. So
hey,
that's
Tom,
really on a one-on-one basis.
I also put a link up there for the Foundation for Financial Planning. That is the Financial Planning Association, as well as a few other service organizations made up of financial planners support. And it's a pro bono, it can link you up with different pro bono advisors out there.
Right. And I think they do some qualification. So they do pro bono financial advice, but it's typically for somebody that can't afford
Right.
necessarily to pay for financial advice on their own. Another question came up as to, how financial advisors that they want access to accounts and things like that. So that's typically what we do. We manage people's money. We manage their planning goals, as we talked about before, having different accounts for different goals. But I would say the majority of financial advisors actually manage clients' investment assets. So for my clients, mostly retirees, they don't have time or the expertise necessarily to manage their money. So I do it for them, and they pay me to do that. That's typically the way most financial advisors. So it's not unusual. There are some protections built in with most of us. We typically have the assets are custodied at a large firm like Charles Schwab or TD Ameritrade. Their job is to protect your money from us. You give us limited permission to do trades in the account. That's basically all it is. I can't take my client's money and send it home to my house. I just can't do that.
I would say, though, the industry is evolving, that there are definitely financial planners and financial advisors out there that work in different business models on how they're compensated. So, like Tom said, some people will hire an advisor and, they pay us a fee for that ongoing advice and monitoring of their portfolio. But there are a lot of people that are do-it-yourselfers, and, a lot of the information is out there for you to discover yourself. And maybe they, just want to pay someone for, there's different models, like you could pay someone by the hour, or there's even people that have like subscription services now where it's a subscription society, right? You pay so much a month to have access to. So I wouldn't let, a lot of people feel intimidated maybe to reach out to a financial advisor if they feel that maybe they haven't accumulated a lot of assets. But there definitely are people out there that are willing to work. Up to everybody freeze?
No, we're here.
I'm good.
You did. No, you did.
Oh, I did. Oh, okay.
You're fine.
There's a couple more questions about 401k versus Roth.
Yep, big fan of Roth. I mean, so to just go quickly through the difference, Roth is no tax savings now. It grows tax deferred, and in retirement, it's going to come out tax free. Whereas a traditional, you get a tax break on the way in. It still grows tax deferred, but then on the way out, you're going to owe taxes. And so really, when you're looking at which one to do, you need to ask yourself, are my taxes to my tax rate, is that going to be higher now, or is it going to be higher in the future? For many people just starting out, the answer is probably tax rate is going to be higher in the future. So a Roth most likely would work out better for a younger person in a lower tax bracket. If you're mid-career earning a lot of money and you're at a higher tax bracket, it may be better to try to capitalize on that and use the traditional to get the largest tax break that you can, and then figure out the taxes later. So that's just the general thoughts on it, but there's definitely more fine-tuned specific advice.
Okay.
Sure. In my practice, we look at what we call tax diversification. So we look a little bit of everything, right? Because I have a crystal ball, believe it or not, but it's out of order. It doesn't work. So, I don't know what tax rates are going to be. I have some suspicions that they're going to be much higher for most of us later in life. So certainly paying what the rate that we know what it is today, especially if it's 12 or 22%, makes a lot of sense. But a lot of the work that I do is trying to, illustrate, well, what if it's this and what if it's that? What if we do this much Roth, that much not Roth, and just kind of make some decisions from there. Most of my work is collaboration with clients. I don't tell people what to do. It's more like, okay, here's what it would look like if you do this, and really make sure everybody's comfortable with what we go forward. It goes back to the question about working with an advisor. That's what most of us do. Not all of us, unfortunately, but most of us, that's the way we work.
And then just the last question, somebody has a 401k from a previous job that she's not putting anything into right now. And should she move it into a Roth and adding a little bit every month?
Well, first off, if it's a traditional 401k that you put the money in pre-tax, if you convert it to a Roth, it'll be a taxable event. If you're not sure, I wouldn't necessarily do anything right away. I would make sure that you're, that you really know what it is before you do anything. I mean, that could be a significant tax hit. You certainly don't want to let them send you the money directly, because then it's also taxable. And if you're not 59 and a half, then there's a premature distribution penalty of 10%. So there could be some bad things. So I would make sure you do some research or get some advice on
Kristen,
what to do.
I would also share that a lot of times, whoever your new employer is might have a 401k, and depending on how the plan was written, many firms allow for participants to roll over old 401ks into the new one. So it is some way that you can make sure you're keeping everything in one place.
Right. I mean, right now as graduate students, they don't have that option. So it would be down the road when they have a job.
Right.
Yeah. So you do have the option to leave it where it is as well. So they're not gonna, well, they can boot you out, but if they haven't at this point, they're probably letting you keep they're probably letting you keep the account there. So you can let it stay there for as long as you want to have it there. The other option would be to roll it over into an individual retirement account where you could have control over it and invest it how you want. Normally, options within the 401k plan are going to be limited to a couple different funds, but it just, you can do with it pretty much whatever you want to do with it.
And then the last question is, it feels intrusive to have a financial advisor who has access to all of their information and accounts. How do you answer that?
You've got to build trust.
I would say that, it could feel intrusive of understanding why an advisor wants to be able to trade your account without talking to you about it. And I would say for our firm as fiduciaries, if we are making a decision on a strategy, I'm just making this up. Let's say for whatever's going on, we decide that we want to reduce our exposure to international companies by 2%, and let's say that goes through our finance committee and it's agreed that, in this portfolio, we're going to make this change. In the old world, I used to have to say, okay, well, we're going to make this change. Who am I going to call first? Am I going to call my mom and dad? Or am I going to get up, pick the phone and call our biggest client? And for us, it didn't feel like that was being a fiduciary. So as a fiduciary, if we're going to make a change to that strategy, we want to be able to make it across the board for all of our clients at one time. So that could be a reason why they want that. So I would try to understand, the intent behind it. Now, as a having access to your savings account, maybe that could be where you decide that you want to systematically add to your portfolio a certain amount of time, a certain amount each month. So you might want there to be an automatic pull or a push. So that could be a reason why the advisor might have that. So I would, understand the intent, and then I always, the sniff test or the feel, like, does it, if it doesn't feel right, then, trust your instincts.
Right. You don't have to work with the first advisor that you talk to, or the second or the third. If you're not comfortable, if they have not done a good job or good enough job of explaining what they do, why they do it, how they do it, what that means to you, walk away. Don't feel bad. They got plenty of other people in the phone book that they can call. I wouldn't feel bad. If you're not comfortable, don't hire them. You don't have to.
Facts.
Yeah. Like searching for a dentist. And I think the difference between the Roth IRA and the Roth 401k is that the 401k, they determine where the money is invested for the most part, and the IRA, you get to have some flexibility, correct?
Yeah, the 401k is going to be employer sponsored, so you only have that if the employer offers it. The contribution limit is also higher on the 401k versus the Roth IRA. It's 19,500 versus 6,000 in a Roth IRA. So that's a slight difference there. But in terms of the taxation, it works exactly the same, where it grows tax deferred and comes out tax free in retirement. And there's also still time to do a Roth IRA for 2020 if you wanted to do one as well. You have until tax filing date to backdate those contributions so you can still contribute $6,000 for a 2020 Roth contribution if that's something you're looking at doing.
If you had the earnings.
Yeah, if you had the earnings.
All right. Well, thank you, all three of you, very, very much. Justin, Diane, and Tom. Really great conversation. Thank you to all of the attendees. Some of them I know had to leave a little earlier, but we had a good turnout and great questions, very engaging. And join us on April 20th for more about the IRA 401, 403 mutual fund discussion. Okay. Look for that email. Take care,
Thank you.
everybody.
Very good. Take care, everybody.
Thank you, guys.